Hey everyone, welcome back to Corporate Decoder, the place where we try to figure out what these corporate filings actually mean for the companies and for your money. Today we are diving into a report from the Even Heard Long Short Exchange Traded Fund. And boy oh boy does this one have some interesting numbers for us that might just make you scratch your head. Grab your coffee and let's see what is really going on. Before we jump in, if you enjoy getting these no-nonsense breakdowns of financial documents, then make sure you are subscribed. And hey, if you want to chat more about these companies, join our Discord community. It's linked in the description below. So we are looking at a semi-annual shareholder report for the Even Heard Long Short ETF, specifically for the period of the 1st of April 2025 to the 30th of September 2025. Think of this as a checkup for the fund to see how its investments are doing. They like to show how much it costs to invest in this fund. For a hypothetical $10,000 investment, the costs here were $185. That might sound small, but when you look at it as a percentage of that $10,000, it comes out to 3.41%. Now this percentage is annualized, which means they are saying if you kept that $10,000 invested for a full year at this rate, you'd pay about $185. This is a pretty important number because a fund's costs can really eat into your returns over time. Let us look at some key numbers for the fund as of the 30th of September 2025. The fund size is about $57.9 million. That might sound like a lot, but it is actually not a giant fund. It holds 196 investments, which is a pretty decent number of different things it owns, or has bet against. The total advisory fee was $310121. This is the money paid to the people managing the fund. And the portfolio turnover rate was 97%. This means they are buying and selling a lot of the investments within the fund. A high turnover rate can sometimes mean higher trading costs and potentially more taxable events for investors. Think of it like a store that constantly changes its stock. The more it changes things, the more effort and money it takes to keep it running. Now let's talk about what the fund is invested in. It looks like they have about 1.026% in common stocks and a tiny bit 0.137% in money market funds. They also have 0.014% in real estate investment trusts. Interestingly, they have a negative 0.177% in cash equivalents. This might sound confusing, but it often means they are using cash strategically or have obligations that make this number appear negative. This is where things get really interesting for a long-short fund. They are not just buying stocks, they are also betting against them. They have negative 0.023% in real estate investment trusts sold short and a substantial negative 0.396% in common stocks sold short. Remember, the negative sign here means they are short these securities, making a profit if their prices go down. The fact that they have a significant portion of common stocks sold short indicates a key part of their strategy is to profit from or hedge against declining stock prices. Let's look at their top 10 holdings. This tells us which companies the fund has the most faith in, or at least the most exposure to. Kinross Gold Corporation and Solaris Energy Infrastructure are each at 1.5%. NRG Incorporated is also at 1.5%. Esquire Financial Holdings Incorporated is at 1.5%. Robinhood Markets Incorporated is at 1.4%. Agnico Eagle Mines Limited is at 1.3%. Vistra Corporation is at 1.3%. Ramaco Resources Incorporated is at 1.3%. Sprott Incorporated is at 1.2%. And Skeena Resources Limited is at 1.2%. Notice a trend here. Many of these are related to energy, mining, and financial services, which aligns with the types of companies they are shorting as well. Now we get into the really detailed part of the filing, the schedule of investments. This is where the fund lists every single thing it owns. They have common stocks making up a hefty 102.6% of their assets. This is a bit unusual because it is over 100% of their net assets. This is typical for a long short strategy where the total value of long positions can exceed 100% of the fund's net assets to accommodate the short positions. They break down their common stock holdings by sector. For example, in aerospace and defense, they hold Amprius Technologies Incorporated Embraer Helmet, Aerospace Incorporated Kratos Defense and Security Solutions Incorporated L3 Harris Technologies Incorporated Leonardo da S, Incorporated Mercury Systems Incorporated Red Cat Holdings Incorporated Rock, ETLab Corporation, and TAT Technologies Limited. The total value of these investments is over $59 million. The cost of these investments was about $48.8 million. This means overall the fund's long positions have gained value since they were bought. Digging into the sectors further in the bank sector, they hold over $4.4 million worth of stocks, including ones like Bank of New York Mellon Corporation, Deutsche Bank AG, and Esquire Financial Holdings Incorporated. In the electric sector, which has exposure to companies like Entergy Corporation and Vistra Corporation, they hold over $3.8 million. In the mining sector, a really significant part of their holdings, they have over $5.3 million invested in companies like Agnico Eagle Mines, Limited Kinross Gold Corporation, and Newmont Corporation. It seems like they are making quite a bet on the mining and energy sectors. This is the other half of a long-short fund, the securities they have sold short. They have common stocks sold short amounting to a negative 39.6% of net assets. This means they are betting against stocks worth over $22.9 million. They are shorting companies from advertising and agriculture to apparel, auto manufacturers, and banks. For instance, in the bank sector, they have short positions in merchants, Bancorp Triumph Financial Incorporated and Walker and Dunlop Incorporated, totaling over $889,000. In the biotechnology sector, they are shorting companies like Regeneron Pharmaceuticals Incorporated and Vertex Pharmaceuticals Incorporated. A substantial chunk of their shorting is in the commercial services sector, where they have positions against over $2.6 million worth of stock. The proceeds from these short sales are over $23.5 million. Notice the negative signs here indicating these are liabilities or bets that the price will fall. They also have negative 2.3% in real estate investment trusts sold short, which is over $1.3 million. In total, they are shorting securities valued at over $24.2 million. Now let's look at the statement of assets and liabilities. This is like the fund's balance sheet. On the asset side, they have $68.1 million in investments. They also have a deposit at the broker for securities sold short, which is $14.3 million. This is the collateral they need to hold to make those short bets. They have cash of $221,807 and other receivables. Total assets are over $83 million. On the liabilities side, the securities sold short are valued at $24.2 million. They also have payables for investments purchased, and to their advisor, bringing total liabilities to about $25.4 million. This leaves them with net assets of about $57.8 million. This is the actual value of the fund. The NAV per S-share is $23.44. The cost of their investments on the books is $57.4 million. This means their current long positions have gained about $10.7 million in value since they were purchased. This statement shows how the fund made or lost money over the 6 months. Investment income from dividends and interest was around $824,000, but their expenses were higher at $920,000. This is a net investment loss of about $95,000. Not great, but expected for a long-short fund where the shorting costs can add up. However, the real story is in the realized and unrealized gains and losses. They had a net realized gain of about $758,000 from their trades and other activities. But the big number is the unrealized appreciation on investments, which is over $8.3 million. This is the paper gain on assets they still hold. They also had a loss from unrealized depreciation on securities sold short of about $966,000. Combining all these, the fund had a net realized and unrealized gain of over $8.1 million. This resulted in a net increase in net assets of over $8 million for the period. That is a significant gain driven mostly by the appreciation of their long positions. Looking at the statement of changes in net assets over the 6 months ended the 30th of September 2025, the net increase from operations was over $8 million. They had further increases from capital transactions, meaning more money came into the fund than left it through share sales and redemptions. This led to a substantial increase in net assets from $48.6 million to $57.8 million for the period. The financial highlights give us a per share view. The net asset value per S-share at the beginning of the period was $20.12 and it ended at $23.44. That is a total return of 16.50% for the 6-month period. That is a very strong performance and indicates the fund's strategy was working well during this time. Keep in mind this is not annualized though. The ratio of expenses to average net assets was 3.41%. This confirms our earlier cost calculation. They also report a ratio of dividends and interest expense on securities sold short to average net assets of 2.26%. This is a hidden cost of shorting that investors need to be aware of. Now we get to the really important details in the notes. The fund is part of Tidal Trust III and is managed by Tidal Investments LLC as the advisor and even Herd LLC as the sub-advisor. Their investment objective is to seek long-term capital appreciation. Under security valuation, they use market prices, but also have procedures for fair valuation when prices are not readily available. They categorize inputs into Level 1, Level 2, and Level 3. Level 1 is quoted prices in active markets, Level 2 is observable inputs, and Level 3 is unobservable inputs. All of their investments as of the 30th of September 2025 were in level 1, meaning they are valued based on readily available market prices. This is good because it means the valuations are likely very reliable. This section is crucial. They highlight equity market risk, meaning stocks can drop suddenly. Then there are short sale risks. This is important because short selling can lead to unlimited losses theoretically. If a stock they bet against goes up a lot, they can lose more than they initially invested in the short sale. They also mention momentum investing risk, which means they are betting that stocks that have been going up will continue to go up and stocks that have been going down will continue to go down. This strategy can be volatile. The advisor receives an investment advisory fee of 1.15% of the fund's average daily net assets. What is interesting is that out of this fee, the advisor is supposed to pay for almost all the fund's operating expenses. The advisor receives a fee of 0.05%, which is paid by the advisor. So essentially, the advisor is taking the 1.15% fee and paying all the other costs, including the sub-advisor from that. This is a common structure to simplify things for the fund. Tidal ETF Services LLC is also involved as administrator. Shares of the fund trade on the Nasdaq. Market prices can be different from the net asset value. They also mention creation units, which is how big blocks of shares are created or redeemed. For retail investors, most transactions happen on the secondary market through a broker. They acknowledge current market volatility due to inflation, interest rate changes, recession, fears, geopolitical events, and conflicts. This is just a disclaimer that the market is unpredictable and can affect the fund's performance. Now let's talk about our take on the Even Heard Long-Short ETF based on this report. On the positive side, the fund delivered a very strong 16.50% total return for the 6-month period. This is largely due to their long positions gaining value in their favored sectors like mining and energy. The fact that their investment valuation is all in level 1 is also a sign they are investing in liquid assets with clear market prices, reducing valuation risk. However, there are some important things to consider. The 97% portfolio turnover rate is quite high. While it didn't seem to hurt them in this period, it can lead to higher trading costs and potentially more taxes over the long run. Also, the 3.41% overall cost and the 2.26% expense specifically for shorting securities are significant. They are essentially paying quite a bit for the fund's management and for the privilege of shorting stocks. The risk disclosures are also very clear about the potential for unlimited losses with short selling and the volatility associated with momentum investing. Investors need to understand that while this strategy can lead to big gains like we saw in this reporting period, it can also lead to significant losses if the market moves against their bets. In conclusion, the Even Heard Long-Short ETF had a very successful reporting period driven by strong performance in its long equity positions. The management team seems to have a good handle on the sectors they are investing in, and the market conditions aligned favorably for their strategy during this time. However, the costs are a factor to watch, and the inherent risks of short selling and momentum strategies mean this fund is definitely not for the faint of heart. It is a high risk, high reward play. Alright, that is our breakdown of the Even Heard Long-Short ETF report. What do you think about their strategy and performance? Do those costs and risks make you hesitant or excited? Let us know in the comments below. If you found this analysis helpful, please hit that like button. It really helps us out, and subscribe for more deep dives into the world of corporate finance. And don't forget to join our Discord community for more discussions. Thanks for watching, and we will see you in the next video.